Hello again. Welcome to Chapter 10, Evaluation of Revenue Management Efforts in Lodging. So far in this class, we talked various issues revenue managers face and how they approach to, like, for example, pricing, inventory management, distribution management. But how do we know whatever we decided to do was the right one? So in this chapter, we will go in a little more detail on primary measures of revenue management performance. We're gonna focus on some examples from the STR, Smith Travel Research reports, and also we are going to try to understand competitive sets and also some additional assessments related to lodging. Now, let's start talking about some of the terms you already learned with an example. You are the owner, and I am the manager. And if I tell you hotels ADR average was $149 last month compared to our competitive set, let's say $119, does it make you happy? How about our hotel's occupancy average was 90%? And the competitive sets were about 70%. What exactly does this mean? Because we discussed previously that if I give you those values separately, for example, ADR could be high, but what if you sold only one room with that price? Or say hotel is sold out, we have 100% occupancy, but that happened because our prices were extremely low. So what exactly those mean? That is why we said we need to consider ADR and occupancy together. That is why we usually use RevPAR. That's what we learned so far. However, RevPAR also has a major limitations. It incorporates only room revenue. Let me give you an example. We have two hotels, both with 400 rooms. Alice Hotel sold 80% of the rooms for $200 and achieved RevPAR of 160. Amanda, on the other hand, sold only 50% of the rooms for 320 and got same RevPAR of 160. Which one did a better job? If you recall from our previous Apply What You Know videos, you already know that answer is not that simple. I know you are already considering a couple things. First, what about operational cost? Because Ellie sold more rooms, and that means she incurred additional costs, like such as cleaning the rooms, additional employee supplies, etc. And one might say, considering those costs, Amanda did better job. Second thing, however, one could argue that because Ali sold more rooms, those people most likely spend more money in the property, such as food and beverage, spa, gift shop, etc. So important lesson you need from this slide is, as I repeated many times, you should always consider the whole picture. If you focus solely on RevPAR, sometimes you can miss other part of the picture. However, I don't want you to dismiss RevPAR because I and my colleagues did a research previously, like 6, 7, maybe 8, 10 years ago almost, and we find out that RevPAR is highly correlated with GopPAR. And considering how easy to calculate and use RevPAR, we still use it extensively in our field. But the idea here, you should learn to look at the whole picture. You shouldn't focus on just one part of the whole picture. Let us talk a few other key performance indicators we use in lodging. This is another topic we talked previously in distribution channel management. We said that we can use distribution channels because they are easier to access. They might have a different marketing segmentation, etc. We talk about if I remember, it was a chapter 8. But it usually costs us to use them. So yes, we have access to different distribution channels, but it's usually cost to use them. Now, net revenue per available room gives us the RevPAR value after channel cost taken out. Let us look at our example. First line gives without considering channel cost, and RevPAR is 141.75. When we adjust with channel cost, it drops to 113.4. So the major issue with this KPI is that sometimes it could be very hard to calculate exact cost of the channels. Next KPI is I want to talk about is revenue per occupied room and total RevPAR. The RevPOR was a response to issues considering only room revenue and how occupied rooms affects overall revenue. This calculation basically includes all the revenues, mainly of course coming from room, but an additional such as food and beverage, meeting space, convention services, gift shop, parking, golf, spa, and other incomes. It is divided to how many rooms occupied. Similar to ADR approach we talked earlier, high RevPOR with low occupancy could be bad for business, right? Where you have a very high RevPOR, but there's only very low occupancy. That's not a good business. That is why total RevPAR approach could be better measure. It exactly works like RevPAR, but incorporates all the revenue. Revenue includes total revenue, rooms, and non-room sources of income divided to available rooms. While we're using many KPIs, one of the most preferred one is the gross operating profit per available room, where total revenue minus controllable expenses divided to available rooms gives us GopPAR. It could be expressed as dollars or as a percentage of total revenue. As you might realize, one of the important thing, it uses total revenue, meaning not only rooms revenue, but all of the revenue. The GopPAR also uses number of available rooms and costs, so it is better KPI than RevPAR or RevPOR. The major issue is with this is very hard to get daily cost into formula. STR, Smith Travel Research, used to have a yearly reports like host reports, but recently started to publish monthly reports for some properties, but the daily is very hard right now. So another thing is you might see the term flow through in your accounting classes. It is not might be directly relevant to revenue management, but it is helpful to show relative change in profit dollars as a percentage change. So instead of just focusing on revenue increases, it also considers gross operating profit. In this example, difference between gross operating profit divided to difference of revenue gives. Like for example, you are getting the new gross operating profit minus the, let's say, last season's gross operating profit divided the same thing using the revenues. In this example, gives us 73.4% flow through. The idea here, as I mentioned many times, just focusing on increasing revenue sometimes might not be beneficial due to additional cost, right? So in our example, for every dollar increase in revenue is 73.4% of it's converted to gross operating profit. So it's very good. By the way, this usually considered the good when number is over 50%. It is, however, could be a problem for revenue managers to access some of these numbers, at least in day-to-day basis. STR or Smith Travel Research is a private company, provides trend analysis, host reports that detailing actual info on revenues, profit and expenses, basically accounting data, pipeline reports, both historical, under construction, and in planning stage supply data, which means like how many hotels out there under construction or planning to be built, destination reports, and star reports. That's especially star reports. If you are any kind of manager, you're gonna get day to day. That helps you to analyze hotel performance for occupancy, ADR, RevPAR, and more. If you're really interested in revenue management, it could be a good idea to get CHIA certification in hospitality intelligence analytics, or in that is a basic certification to learn all about STR reports, but it might be very beneficial. Now, considering that we don't have enough time and there are dozens of different reports, but I just wanted to show you a page from monthly performance report. If you look at some basics here, first, let's look at the occupancy, right? Occupancy for current month is, what is it, 79.1%. And looking at running 3 months and 12 months results, if you recall from this calculations, if you look at the 3 months and 12 months runnings versus the current month, comparatively we are getting better in current month. Important thing here, however, compared to other comp set, which is 69.8%. So yours was 79.1, comp set was 69.8 for the current month. So we are doing better than our comp set, which is also reflected by occupancy index that is 113.3. However, our ADR is lower than comp set. When we combined occupancy and ADR, our RevPAR is a little better than our comp set, but considering 10% more occupancy, we need more information if we are profitable or not, depending on cost or additional revenue of those additional 10%. I don't want to get into too much into detail, more than what book chapter covers, but I just want to give you a glimpse of one page from one of these reports. While there are not detailed reports in the book, you still need to understand some terms and analytical approaches. Let us start with the competitive set. When we say competitive set or comp set, we are talking about your competitors, which you should consider your performance to, compare your performance to. I will give you some examples in a few minutes, but a group competitive set is group of 4 or more similar to your properties selected for your competitive set. Now, second term is what we call it index, okay, which measures your performance relationship to your comp set. If index is 100, that means your performance equal to comp set average. If index is lower than 100, you are doing poorly, and if it's greater than 100, you are doing better than your comp set. Now, for example, just to give you a little bit more things, but we will go all over them. But occupancy index means index designed to measure a property's shares of rooms sold. Average room rate index is basically ADR compared to your competitive sets. RevPAR index, we just talked about it. Market share, supply is the proportion of the market room controlled by the subject hotel. Market share demand is the proportion of the market's total rooms sold that were sold by the subject hotel. And actually, last one supposed to be market share revenue. Oh, okay, I'm just looking at the wrong place. The proportion of the market's rooms revenue captured by the subject hotel. So they are looking at the market share-wise 3 things. How much of the supply is controlled by your hotel? How much is the sold by your hotel, and how much is the revenue captured by your hotel? But we will go all over all of them. I'll give you some examples right now. First, index calculation. What's the means by index calculation? I'm gonna use the occupancy index example here. Index calculation is basically performance of subject hotel divided to performance of comp set. Okay, that's the important differentiation. Your hotel divided by the comp sets. Now, let's give an example here. There is if your hotel has a 70% occupancy and your comp set also 70% occupancy, your occupancy index is going to be 100. Okay, so basically you are at the same level as of your similar to your competitive set. But if your occupancy is 70%, if your comp set's occupancy increases 75%, your occupancy index drops, okay, to 93.3. So which means your occupancy index is less than 100. From occupancy perspective, you are doing worse than your comp set. Now, in a typical STR report, the subject, your hotel performance, is indexed against its competitive set. You need to understand that. They also create ranks, like you are first in the set, second in the set, third in the set, and on each criteria is listed. By the way, you don't exactly know who your competitive sets are. That's an important thing, because you cannot single out one competitor to try to get their numbers. The report doesn't allow that. But as a revenue manager or any kind of future manager, your goal is typically an index of 100 plus, more than 100%, not percent, 100 plus, more than 100. The idea behind index is you compare your performance to other properties. Okay, that's the part of the competitive set index or competitive index calculations are. Let's say your RevPAR was 100 last month and increased to 120. Now, did you do a good job? I mean, without knowing more, we don't know, right? Let me give you an added to that. Let's say there is two different scenarios. Let's say your competitors last month RevPAR was also 100. They increased to 110. Or in another scenario, they increased to 130. Now, because of the dynamic environment we live in, prices always change. Like in the first, like let's say we don't have a competitive set, we are just looking at the 100 to 120. Without comparison, we might not be sure price increase from your management performance or just other external factors. But when we compare to others whom also affected by same market and external factors, for example, in scenario 1, right? So we did better than our competitors. As we can see, our index is 109.1. And in scenario 2, we did worse than our competitors as reflected by RevPAR index of 92.3. So that's why the competitive index are good for us. Now, it is good to use index. I know it's getting more complicated in a sense, but it's good to use index to compare our performance to our competitors. But however, as always, we should always consider different KPIs to understand what is really going on with our property. Like in this example, there are 5 different scenarios with exactly the same RevPAR index, which is in this example is like 100. Okay. Now, our RevPAR index 100, which means we are exactly the same level with the comp set. But let's look at the first one. Occupancy index is low, ADR index is high. So which means our occupancy is doing worse, actually not necessarily worse, but less than our competitive set. But ADR index is doing much better. So exceptionally high rates leading to excessively reduced occupancy rate because our the ADR or our price was high, is reflected in the ADR. That's why the occupancy dropped. But somehow we were able to get the still 100 RevPAR index. If you look at the second one, that still strong rates, but higher room-related occupation cost than in scenario 1. Okay, because our occupancy went up while the ADR went down. We still get the same RevPAR index, but our other values changed. Now, number 3, we are all equal to competitive set performance in any fields we talk. The fourth one, we have a low rates, higher room-related occupation cost than in scenario 2, assuming, right? Now, if you look at the ADR, which means you lowered your price, that's why occupancy went up. So in the fourth one, you lowered your price is so low, your occupancy went up extremely compared to your competitive set. Now, why we are talking about this? Because once again, just don't look at the RevPAR index per se also. I mean, you might look like in RevPAR index perspective, you are on the same level with your competitive sets, but there could be other things that needs to be considered always. Okay. Now, following the earlier example, I want to give some of the things, like for example, when the RevPAR index above 100 and RevPAR index is below 100. In the first thing, if you have a RevPAR index above 100, but you have a strong occupancy but average ADR index, that indicates that guests perceive strong value at current rate structure, okay, and that many likely would be willing to continue booking even at higher rates. Okay, let me repeat that. Your average ADR index is like average ADR index means your ADR is similar to your comp set, but you have a stronger occupancy index, which means even if you are at the same prices with your comp set, people reserving more room from you. So that's in the case you find better value in your property. Just to give you an example. Second example is the average occupancy strong ADR index. In the case guests perceive strong value at current rate structure. So which means you are charging more, even you are charging more, they are still at the same level at the comp set. So it might be a good idea to, for example, maybe offer discount if you want to select demands the period, fill more rooms, for example. Third one is a strong occupancy and strong ADR index. That's in the case that guests perceive strong value at current room rates and the property's market position is strong. So you might want to maybe increase rates and service level during periods of highest demand to maintain and expand market dominance. So you are in very good condition. Now, however, if the RevPAR index is below hundreds, now it could be also from several reasons, right? We are giving an example here. Like first is the weak occupancy average ADR index. Now, that's in the case that average guest does not perceive strong value at the current rate structure. So you need to carefully re-examine marketing efforts as well as service levels prior to seeking to expand customer base or increase rates. Second reason you might have a low RevPAR index is the average occupancy or weak ADR index and weekend ADR index. Now, that indicates that guests perceive value, but only at reduced rate. So basically, when you lower your price, they start to get into your property. So you need to carefully evaluate maybe physical facility and maybe service levels prior to seeking increased rate. You cannot just increase rate and expect to be we're gonna get better RevPAR index, right? That is because if they are coming into the same occupancy level at similar to your comp set, but at lower price, that means they only come to you because your price was low. So you need to figure out why they are not seeing a good value in your property. And if you have a weak occupancy and weak ADR index, that means a very poor guest perception of products and service levels at the current rate structure. So you need to basically check everything: marketing efforts, product service levels, and facility quality, as well as maybe brand affiliation. Otherwise, it's going to be very hard to fix this. There is something going wrong with your property. Last thing I want to talk in this chapter is market share analysis. We use this analysis to understand room supply, demand, and revenue, and how much of that captured by your property. These are the formulas used, as you can see. Formula is similar to all, right? You got the subject hotel divided by the comp set plus subject hotel. That's the important difference here. So market share includes your property as well. Now let's give an example. By the way, you can read more detailed explanation of this table on page 311, if I remember correctly. I'm just going to give you a couple examples to make the video a little bit short. So let's consider January as average. If you look at the February supply, it's still same, meaning rooms available are the same, both your property, and the comp set. So demand to your property increased. That is good, right? Comparing January to February. That's meaning you sold more. You captured more market demand share, but your revenue share is lower. So which means most likely you captured more market demand share because you lower your sales price. Okay, so following month in March, however, they still have the same supply but lower demand share and higher revenue. So without much information, most likely considering the February, they raised their prices in March, which means less rooms sold, but even with the less rooms sold, they were able to increase their revenue. And please be sure to read more examples in the book. In addition to all KPIs KPIs. Good managers also continuously monitor who are their buyers, like source of business, which channels they use, and what cost. And finally, always needs to, especially in this time and age, finally, that you need to check what your buyer says publicly about you. So thanks for watching once again.